Hi there. Now, as we know, there are basically two ways that traders analyse the markets in order to make a profit. First of all, you've got the fundamental analysis, which is basically looking at the economic reasons why an individual country's currency is going to be strong or weak, therefore bought or sold. Or in the case of stocks, you may look at the company's balance sheet, looking at the profit and losses, and so forth. Or we can use technical analysis, which is basically the process of looking at what price has done in the past in the hope that it will give us clues to what prices may do in the future. We're looking for patterns and trends of recent price behaviour. Now, in order to do this, we look at charts, and the charts come in varying different formats. The chart is basically, as you know, has two axes. You have the horizontal axis, which is always time, and you have the vertical axis, which is the price. Now, when we're trading Forex, we're basically using three different chart types, and we're going to discuss those with you now. First up, we have the line graph. Now, the line graph basically looks something like this. Okay, now each point on a line graph is a data point, and it represents the closing price on a particular time period. So, for example, if this was the daily chart, each point on this line chart would represent the closing price of that particular Forex pair or stock on that day. So it ignores the highs and the lows, it just focuses on the closing price on that particular time period. Now, in fact, using the daily chart on the line chart is one of my key tools that I use when I'm plotting support and resistance, and we've got more about that in a future video, so make sure you check it out. Now, after the line chart, we've got the Japanese candlestick chart. Now, the Japanese candlestick charts are the most commonly used form of charts that people use in the Forex market, indeed any market for that matter. Certainly the simplest to understand. They show us lots of information as well. They were invented apparently by the Japanese rice traders some 200 years ago. So they were working for the Japanese then, so clearly they're going to work for us now as well. But they do show us lots of information as well, which is why we use them. Before I get into all that, let me explain to you exactly why we use them. Remember the line chart. The line chart shows us data points where prices close in a particular time period. But as traders, we want to drill down. We want to drill down to see what price was doing within that particular time period to help us give us clues to what prices may do in the future. Now, they show us lots of information, as I said. Typically, a blue candle will represent that prices closed higher than where it opened. So, for example, price may open down here, close up here, and because it's coloured blue or sometimes green, it shows us that the market was moving up, it closed higher than where it opened. But it also shows us the high of that particular time period, where prices went to at the highest level. Also shows us where prices went to at the lowest level. So it shows us lots of information. These are often referred to as wicks or shadows of the candle, by the way. So it shows us 5 parts of price action. It shows us the open, the close, the high and the low, and the fact that it's blue indicates prices were moving up. Conversely, if it was a red candle, prices would have opened up here, closed down here, you've got the high possibly up here, and the low with this wick down here shows us the low. Again, 5 bits of information. As traders, we bunch all these candles together and it gives us a picture of what price was doing in the past, and we look for patterns, and these patterns help us predict where prices may go in the future, and a lot more about that later on in the trading lab. And lastly, you've got the bar chart. Now, the bar chart shows us lots of information again, but not maybe quite as graphical as the candlestick chart. It shows us what the high of price was in that particular time period, the low, shows us where it's opened with a tag normally to the left, and where it closed with a tag to the right. And when you put all these together on a chart, it helps us show patterns again and clues to see what price has done in the past, helping us predict what prices may do in the future. So there you have it. There's 3 different types of charts that we use when we trade in the Forex market. You've got the line chart, which is great for using support and resistance on the higher time periods. You've got the candlestick chart to help us show what price has been doing in the smaller time periods, looking for patterns, helping us predict future price movement. And you've got the bar chart, which does pretty much the same as the candlestick, but just not as graphical. And later on in the course, we're going to show you how you can use these different chart types, the line chart for drawing support and resistance on the higher time periods, the candlestick charts looking for specific price patterns, which will help us predict where prices may go in the future, and indeed the bar chart as well. So make sure you stick around for the rest of the course. See you in the next video.